for Bitcoin to be worth 1,250,000 over the next 5 years. I got to be honest, has even some Bitcoin bulls thinking it might be too aggressive. So walk us through this.
Sure. Well, the way we get to that number, now that is our bull case. Our base case is closer to 750,000. But the bull case involves a substitution for gold. So as generational wealth transfer takes place, we think that younger people are more prone to adopting a digital store of value. So that would be Bitcoin.
Bitcoin's market structure has changed dramatically over the past several years. What was once dominated by retail speculation and crypto-native trading activity is increasingly influenced. Bitcoin's price is now driven by institutional capital flows, ETF demand, Treasury market conditions, and Federal Reserve liquidity policy. Bitcoin is now behaving less like an isolated technology trade and more like a macro-sensitive asset.
Well, I think that we're beginning to see the asset allocation shift. And yet we think that because of stable coins,
right,
that the dollar will also be strong. So effectively, stablecoin, so USDC, Circle stablecoin, and USDT, Tether's stablecoin, they are backed primarily by U.S. treasuries. So to the extent they become successful around the world, we're going to be effectively exporting dollars, and that should be dollar positive. At the same time, we do think there is an asset allocation shift beginning towards Bitcoin and other crypto assets,
right,
again, because of the low correlation of returns.
Operating inside the global capital system, that transition may be one of the most important financial developments happening in modern markets. To understand why Bitcoin behaves differently today, we first need to understand what ETFs changed. The launch of US spot Bitcoin ETFs fundamentally changed Bitcoin's accessibility for institutional investors. Before ETFs, many pension funds, wealth managers, and registered investment advisors faced operational or regulatory limitations preventing direct Bitcoin ownership. ETFs solved that problem. Now Bitcoin exposure can be purchased through traditional brokerage infrastructure alongside equities, bonds, and commodity products. This transformed Bitcoin from a crypto-native asset into an institutionally accessible financial instrument. BlackRock IBIT saw massive inflows, with Fidelity and ARK Invest following closely. Institutions are adjusting Bitcoin allocations on Bloomberg terminals, but ETF access alone does not explain Bitcoin's growing institutional relevance. Liquidity conditions matter just as much. Bitcoin increasingly trades as a liquidity-sensitive macro asset. When liquidity expands across financial markets, risk assets often perform well simultaneously. When liquidity tightens, volatility rises across equities, high-growth technology stocks, and digital assets. This is why Bitcoin now reacts closely to Treasury yields. Federal Reserve policy is shaping inflation expectations and global funding conditions. Bitcoin has effectively entered the broader macroeconomic cycle. Treasury yields influence nearly every major financial asset. And nowhere is this more visible than inside the Treasury market itself. When government bond yields rise sharply, investors can earn higher returns through relatively lower risk Treasury exposure. That often pressures speculative or growth-oriented assets. Bitcoin increasingly reacts to these yield movements because institutional investors now compare Bitcoin against alternative macro allocations. Higher real yields tighten financial conditions. Lower yields often encourage broader risk-taking behavior. This brings us directly into the Federal Reserve transmission mechanism. Federal Reserve policy impacts Bitcoin through liquidity transmission channels. When the Fed raises rates or reduces its balance sheet through quantitative tightening, liquidity conditions tighten, affecting Bitcoin's market dynamics. Voiceover, macro conditions are tightening across markets. Capital is becoming more expensive. Leverage is declining and risk appetite is weakening. Bitcoin is increasingly responding to these macro conditions. Institutional positioning now plays a much larger role inside the market. But Bitcoin's relationship with liquidity extends beyond central banks. Stablecoins now play a major role in this system. Stablecoins have evolved into one of the most important pieces of digital financial infrastructure. Products like USDC and USDT effectively function as blockchain-based dollars used for settlement, collateral, payment. Liquidity provisioning is essential for efficient digital markets. This matters because stablecoins increasingly connect traditional treasury markets with blockchain settlement systems. This integration is key to the future of finance. Digital dollar liquidity is now circulating globally through programmable financial rails. And that creates a surprising relationship between crypto markets and US government debt. Most large stablecoin issuers hold substantial reserves in short-duration US Treasury securities. That means stablecoin growth indirectly increases demand for Treasury collateral. As stablecoin adoption expands globally, Digital dollars effectively export US dollar liquidity through blockchain infrastructure. This is one reason many macro analysts increasingly view stablecoins not as speculative products, but as emerging components of global dollar distribution systems. Treasury bills are transforming into digital stablecoin flows on institutional dashboards, reviewing stablecoin reserves and unplugged attention to securities. At the same time, to attract attention because of its fixed monetary structure. Unlike fiat currencies or commodities, Bitcoin issuation follows a mathematically fixed schedule. Every 4 years, the Bitcoin halving reduces new supply entering circulation. This creates predictable scarcity conditions that institutional investors increasingly evaluate through long-term macro framework. Bitcoin's supply growth rate is now below long-term gold issuation growth. That distinction matters for institutional allocation models. This is why comparisons between Bitcoin and gold continue growing.